Imagine waking up tomorrow morning. You open your investing app. An Apple stock is down 15%. Your first thought might be, what happened? Did Tim Cook wake up and lower the price? Did Apple decide their stock was worth less overnight? Surprisingly, no. In fact, Apple has almost no direct control over its own stock price. So if the company doesn't decide, who does? Is it Wall Street? The government? The stock exchange? Or is there someone behind the scenes quietly controlling everything? The answer is far stranger than most beginners realize. Because every second the market is open, millions of people around the world are silently voting on what they believe Apple is worth. And those votes can erase or create hundreds of billions of dollars in minutes. By the end of this video, you'll never look at a stock chart the same way again. The biggest lie beginners believe: imagine walking into a grocery store. A bottle of water costs $1. Simple. The store decides the price. Now imagine Apple, one of the biggest companies on earth. Surely Apple decides its own stock price too. Right? Wrong. This is one of the biggest misconceptions in investing. When Apple sells an iPhone, Apple chooses the price. When Apple sells a MacBook, Apple chooses the price. But once Apple shares begin trading on the stock market, Apple no longer controls the price. Not even Tim Cook can wake up and say, today our stock should be worth $300. It doesn't work like that. So, who actually decides? To answer that, we need to visit the world's biggest auction. The auction that never stops. Imagine thousands of people standing inside a giant stadium. Some are shouting, "I'll pay $200." Others yell, "I'll sell for $201." Another person says, "I'll pay $202." This continues. Every second. Every minute. Every trading day. This is essentially how the stock market works. The stock market is not a supermarket. It's an auction. Every price you see is simply the point where one buyer and one seller agree. That's it. No magic. No secret committee. No hidden button. Just buyers and sellers. But then something strange happens. Sometimes, millions of buyers suddenly appear. The price explodes upward. Other times, millions rush toward the exit. Prices collapse. Why? Because the market isn't pricing today's company. It's pricing tomorrow's expectations. And that's where psychology enters the picture. The invisible force that moves billions. Imagine two identical houses. Same size. Same location. Same design. One family believes a new shopping mall is being built nearby. Another family hears rumors of rising crime. Suddenly, people value the houses differently. The houses didn't change. Beliefs did. Stocks work exactly the same way. Apple doesn't need to change overnight. People simply need to change their expectations. If investors believe Apple will invent something revolutionary, demand rises. If investors believe iPhone sales will slow, demand falls. Nothing physically changed. Only expectations. And expectations move markets. Wow moment, here's something incredible. Apple has lost more than $200 billion in market value in a single trading day. That's more than many famous companies are worth in total. Did Apple suddenly lose billions in cash? No. People simply changed their expectations. That's how powerful market psychology can be. The real boss of the stock market if companies don't decide. Who does? You do. I do. Pension funds. Banks. Insurance companies. Mutual funds. ETF managers. Hedge funds. And millions of ordinary investors. Every buy order says, I think this stock is worth more. Every sell order says, I think it's worth less. When those opinions meet, a price is created. That's why stock prices change every second. They're not facts. They're agreements. Temporary agreements. Tomorrow, everyone might agree on a completely different price. Why great companies can have falling stocks? This confuses beginners more than almost anything else. Apple announces record profits. The stock falls. How? Imagine your teacher expects you to score 100%. You score 98%. Excellent result. But below expectations. The market reacts to surprises. Not just success. A company can perform brilliantly and still disappoint investors if expectations were even higher. That's why understanding expectations is just as important as understanding the business itself. The price is just an opinion. Here's the biggest lesson from today's video. A stock price is not a company's true value. It's the latest agreement between buyers and sellers. Nothing more. Nothing less. Think of the market as the world's largest opinion poll. Every second, millions of people vote with real money. Sometimes the crowd is right. Sometimes the crowd is wildly wrong. History has shown both. That's why legendary investors like Warren Buffett don't ask, what is the market saying today? They ask, what is this business actually worth? Because while prices change every second, value changes much more slowly. And understanding the difference between price and value is one of the most important lessons any investor can learn. So the next time you see a stock rise 10% or fall 10% in a single day, don't ask, who changed the price? Ask a better question, what changed people's minds? That question will take you much closer to understanding how the stock market really works. Excellent. Let's make this feel like a Netflix documentary rather than a finance lesson. The invisible battle happening every second. Imagine standing in the middle of the world's biggest auction. Around you are millions of people. A college student investing $50. A retiree protecting their savings. A billionaire hedge fund manager moving $500 million. An ETF buying shares automatically. A pension fund investing for millions of workers. Every one of them has a different opinion about what Apple is worth. Now imagine all of them trying to buy and sell at exactly the same time. It sounds impossible. Yet this invisible battle happens every second the stock market is open. And here's the surprising part. Most trades aren't made by ordinary people. They're made by institutions. Banks. Mutual funds. Insurance companies. Pension funds. Hedge funds. Together, these organizations control trillions of dollars. Imagine trying to swim against a tidal wave. That's what it can feel like when huge institutions suddenly decide to buy or sell. But here's what many beginners misunderstand. Institutions don't magically decide the price. They simply place enormous orders. If millions of shares are suddenly bought, demand increases. If millions of shares suddenly flood the market, supply increases. The price adjusts until buyers and sellers agree again. The market is constantly searching for balance. Almost like a seesaw. Too many buyers? Prices rise. Too many sellers? Prices fall. It's surprisingly simple. Yet something behind the scenes makes this entire system possible. Without it, trading would almost stop. The people you've never heard of. Imagine walking into a supermarket. You pick up a bottle of water. You don't wait for another customer to sell you theirs. The store already has inventory waiting. The stock market has something similar. They're called market makers. Most beginners have never heard of them. But they're one of the reasons markets function so smoothly. Think of market makers as professional shopkeepers. They're almost always willing to buy shares. And almost always willing to sell shares. That means when you click the buy button, Someone is usually ready to complete your trade. Without market makers, buying and selling would take much longer. Prices would jump wildly. Trading could become chaotic. Instead, they help keep the market moving. But even they can't stop panic. And history gives us one unforgettable example. Wow moment, the day the market lost nearly $1 trillion on May 6, 2010. Something unbelievable happened. Within minutes, the US stock market plunged. Almost $1 trillion in market value disappeared. Then, almost as quickly, much of it came back. Imagine walking into a car dealership. Every car suddenly costs half its normal price. 5 minutes later, everything is back to normal. It sounds impossible. Yet that's essentially what happened. This event became known as the flash crash. Investigations later pointed to a combination of automated trading, rapidly changing orders, and panic spreading through the market. The companies themselves hadn't suddenly become worthless. Apple didn't stop making iPhones. Coca-Cola didn't stop selling drinks. The businesses barely changed. The market's emotions did. That's one of the most important lessons you'll ever learn. Prices can move much faster than businesses. And when fear spreads, logic often leaves the room. Can someone fake a stock price? If millions of people determine prices, could someone manipulate them? The short answer is sometimes. Imagine a crowded theater. One person suddenly shouts, "Fire!" People panic. Everyone runs. Even if there isn't actually a fire. The same thing can happen in financial markets. Some scammers buy tiny, unknown stocks. Then they flood social media with exciting claims. This company is about to explode. Don't miss out. Thousands of people rush to buy. The price shoots upward. Then, the scammers quietly sell. Everyone else is left holding expensive shares that quickly collapse. This is called a pump and dump scheme. It's illegal in many countries. And regulators spend enormous resources trying to stop it. But here's the important distinction. Manipulation is not the same as normal market movement. Most price changes happen because millions of investors honestly disagree about what a company is worth. That's healthy. That's what markets are designed to do. A price is an opinion. Value is something else. Imagine two friends looking at the exact same painting. One says, "I'd pay $100. The other says, "I'd pay $10,000. Who is right? Neither. Until someone actually buys it. The price is simply the latest agreement. Stocks work the same way. Today, Apple might trade at one price. Tomorrow, it could trade higher. Next month, lower. But has Apple's business changed that quickly? Usually not. Legendary investor Warren Buffett once said that in the short run, the market behaves like a voting machine. People vote with emotions. Excitement. Fear. Optimism. Panic. But over the long run, the market becomes a weighing machine. Eventually, real business performance matters more than emotions. Companies that consistently create value tend to be rewarded over time. Companies that don't eventually struggle. This is why experienced investors spend more time studying businesses than watching stock tickers. So, who really decides a stock's price? Let's go back to the mystery we started with. Who decides a stock's price? Is it the CEO? No. The government? No. The stock exchange? Not directly. Wall Street? Not exactly. The answer is both simpler and more fascinating. Everyone does. Every investor. Every pension fund. Every ETF. Every hedge fund. Every institution. Every individual clicking buy or sell. A stock's price is simply the latest agreement between buyers and sellers at a particular moment in time. That's why prices can change every second, even when the company hasn't changed at all. So the next time you see a headline that says, Apple lost $150 billion today, remember, Apple didn't wake up and erase $150 billion. Millions of investors simply changed their minds about what Apple was worth. And that's the biggest lesson of all. The stock market isn't a machine that tells you the truth. It's a machine that reflects human beliefs, emotions, expectations, and decisions in real time. Understanding the difference is what separates someone who watches stock prices from someone who truly understands the market. So here's a question for you: if stock prices are driven by what people believe today, how do you think long-term investors decide what a company will be worth 10 years from now? That's where the real journey of investing begins.